The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. Well, our show today for TFNN is being broadcast from Bellevue Psychiatric Hospital in downtown Manhattan. They finally admitted me, and I was the last bear to be admitted. There were 4 or 5 others in the hospital here before I got here. So they let me out today to do the show, so I thought I would give it a shot today and see what happens. I started out today showing the Bradley model. We're over a possible top in the Bradley. We haven't taken out the high of earlier last week up at that 17,160 level. But as Basil pointed out, that we have a two-tiered market. We have, Dow stocks are down on the day 20 points or so. The S&P's up about 7, so it really is a two-tiered market. And I think there's the best chart for seeing this I'm going to show next, but I wanted to talk just a tiny bit more about the Bradley model because it is far from perfect, but when it does catch on, it is pretty difficult to fade it. And, it looks like we are heading down into December by looking at this. There's a lot of things that are happening in the world. I don't mean the geopolitical things. I mean the things that are happening with the overbought indicators and margin debt and things like that. But nobody counts those things anymore. At least not right now. They don't count them. Maybe later on in this cycle they might. But the chart that I really wanted to bring to your attention, I talk about just about every time I get a chance, and that is the chart of the New York Stock Exchange Index. We have barely taken out the high of yesterday. We're still far below. We're right at just a little above the 61% retracement from the high that we made back on July the 3rd before we went in for the Independence Day holiday. So the market is still, we've taken out yesterday's high by just a little bit, I think by about 3 or 4 points in an index that trades for 11,033. Our high today was 11,035, and our high yesterday was 11,034. So it still hasn't run away to the upside, but that doesn't mean that it can't, but it still is showing that the overall abundance of stocks are still far below their highs of July. But they're watching the stock, the index that's on steroids, which of course is the NASDAQ. And then we have the S&P, which is 500 stocks. So we have 600 stocks there, and then the 30 Dow stocks. So we have 630 stocks that they report pretty much on when they're dealing with Bloomberg and CNBC. But that's not the real market. There's thousands and thousands of stocks out there. I believe the NASDAQ has 8,000 issues, and the New York Stock Exchange has just over 3, and the NYSE index is made up of 2,000 of the best, highest capitalized stocks on the New York Stock Exchange. So I'm just bringing that to your attention because I think it's important to pay attention to, statistics and, what markets are actually doing. So I think it's important. Now, I wanted to show you a chart here that I think, actually it's not a chart, it's a little statement of what is actually happening in the market. And I'm just going to read it for our folks that don't have Tiger TV. But we've gone 33 months since we've had a 10% correction or more. There's only been a few times in history where that's happened. 2005, 2007, 1984, 1987. The 87 top was on August the 25th that led to the Black Monday on October the 19th of 1987, and then the one in the middle of the Depression from 1934 to 1937, and of course the big one, which was 1926 to 1929. Those were the times that we've gone 33 months without a 10% correction. There's only 3 times in history where corporate profits have topped 10% of GDP. 1966, 2007, which was right before the housing bubble, and of course right now. So those three times are the only times that we've gone above 10% above GDP on value of the stocks. The stock market capitalization as a percent of GDP was one of the things that Warren Buffett measures of frothiness in the market. Historically averages about 70%. In 2000, the dot-com bubble, we hit an all-time record of 150%. In 2007, in the real estate bubble, we were at 111%. And with our debt bubble, at least I think it's a bubble, we're at 127% as we go to press today. Money market funds are also at the lowest level since 1998. Someone asked a question, what about GDP during 1929? They didn't keep that statistic during 1929. I don't know when it came to being, but evidently it was not available during 1929. So these are just a few of the things, along with the other things that I've been yelling and screaming about here for the past several months. But none of these things mean anything because it's different this time, folks. If there's one thing I'm absolutely sure of, it is not different this time. That much I'm sure of. Whether it's going to end the way I think it's going to end, I'm not sure, but I know that it's not different this time because human beings are always the same. They act the same over history. We never learn from our lessons, and that's one of the reasons why we have to be, so very careful, when we're trading these markets. And believe me, I'm careful too. If you think I'm standing in front of this thing, you're absolutely wrong. I'm just looking for indicators that tell me that we might get ready to turn. Now, today is a P-index day. I believe Steve Rhodes covered it on his early show with TFNN. P-index day is a day where you have either a lot of astrological cycles in the sky at one time or very, very few. And this happens to be one of the times where there's only one aspect in the sky. So it's a very, very rare event. It's only happened 8 times in the last 300 years. I don't know if it's going to affect the market very much or not. But in the past, these things have had a pretty good track record of calling turning dates in the stock market. And of course, we've had a big run-up today in the NASDAQ. The Dow hasn't done very much. It didn't even take out the highs of yesterday. But we certainly have in the S&P, and we certainly have in the NASDAQ, because that thing has just been pretty much of a parabolic move. All the way up. So we'll have to see how high it's going to go. But as Isaac Newton said, what goes up must come down. Maybe not in our lifetime, but it will come down. His law has yet to be repealed, so we'll have to wait and see. Now, I wanted to bring something to your attention today, folks, because it affects all of us. It's money, especially if you do any traveling in Europe. We are looking at a pattern in the euro that is just absolutely a beautiful pattern. We have so many things telling us that the euro could be very, very close to a major bottom in here, and we have we're almost exactly at the 61% retracement of the low we made last September. We've come within actually 3 pips of the actual low in this. If you give me 1 second here, I will try to get this posted into Tiger TV so we can see it, because it shows it's basically a 4-hour chart, but it shows that same pattern that we're looking at in the stock market, with these expanding triangles to the upside. But what we're doing now is we are right at a 61% retracement in the euro down here at this 134.50 level. We're trading at 134.63 right now. So if we go crashing through that, we could actually, go all the way down to the 133.20 level. So we're at the proverbial moment of truth here in the euro as we come to our show here at TFNN. And the euro is the most actively traded thing in the world, folks. There's nothing that comes even close to it. It's thousands of times bigger than the stock indices or the stock market and the bond markets and the note markets. It's just huge because it is cash. It's real money. And it's all the European currencies through the euro, the ECB, and versus the U.S. dollar. That's the cross rate that it trades against. And the history of this, we started this way back in 99. They brought it out at 135. The euro went from 135 down to 85. Then it went from 85 to 160, and 160 back to 100, and then back to 130, 160 again, and then back down to 110. And right now we're trading at the 134 level. So this is a very actively traded vehicle, and it gives you all kinds of opportunities to be either a buyer or a seller. But we are at the moment of truth here in the euro as we come to our show today here at TFNN. That's what it looks like on a long-term basis on the euro. It has the potential to go down a great deal because we're in a long-term downtrend, and we have made lower tops ever since the high that was made back in 2008 when it was trading up at the 160 level during the real estate bubble. And we've had lower tops now all the way through here during 2009, 2011, and again in 2013 and 14. So we have certainly been in a long-term bear market in the euro. But we just completed, 10 weeks ago, we completed a rally that had been going on for 18 months, a rally in a bear market that took us up to a 61% retracement of that move. So this is a real interesting time in the euro. And the reason why I'm bringing it to your attention is I know a lot of you folks don't trade it. Maybe you don't even know anything about it, but it's what makes money move. Because anytime they sell a product in Europe, with U.S. dollars, they have to convert it back into euros. And so that transaction happens through the Forex banks. And believe me, these start early in the morning and they go 24 hours a day, 5.5 days a week. So these are the things that, as a currency trader, you want to be able to, to watch some of these swings unfold because they affect all of our lives. Maybe not the way that we think that they do, but they certainly do because it's real money. Especially if you do any traveling abroad or of course abroad. You could travel in the United States, but you wouldn't need euros. But when you're traveling and the euro is expensive, the cost of your vacation is, very, very expensive. When it's cheap, you get pretty much a good deal on your vacation. So that's why I follow it very, very closely. Now I wanted to spend just a few minutes here. We're going to have a break here. We've got the Dow is as Basil said, it's a bifurcated market. I didn't know you could use that kind of words on the radio, but evidently Basil's able to do that. So this market is bifurcated, and the Dow is down, and the S&P is up about 5, and we have the NASDAQ up about 25. So all that's hold together pretty good. We've got gold is under a little bit of pressure here today, down a couple of dollars. We'll be right back after this message.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I wanted to talk a little bit about the VIX index. Basil Chapman is the master of the VIX index, in my opinion, and I've learned a great deal from it just listening to how he looks at it. But, boy, it certainly follows the patterns of the Fibonacci summation sequence incredibly well. The last time we had a sell-off in the market, I think it was a 3-day sell-off back in April into the 15th of April. The VIX got up to 1785. It had gone from 12 to 17 in a matter of 5 days. It moved, basically 40%. We had a market move this past week from the 16th into the high that we made here, which was the low of the market last Thursday. That was a move of about 40%. So they're very similar moves to what happened in April and what happened now. But what's interesting now, on this sell-off that we've had, we've just made a perfect 786 retracement. When Basil was on the show, he was talking about the 1140 area in the VIX index as being very important, and the low today has been 1141. So he had that spot on, and as long as we stay above 1141, the highs that we're seeing in the market today in the New York Stock Exchange Index and possibly in the S&P and the NASDAQ might hold for a few days until the next 30% move to the upside occurs. So we'll see how this is going to play out. But the VIX index is very, very important from a technical standpoint, because it really does take the market up to an area where at least fear and greed, comes out. Folks, if a market can go from 10 to 15 in a matter of a couple of days, it's ringing the bell that there's something out there that is not the way some people appear that it might be. So just remember, when this VIX index moves, it can really go. Back in the 2008 debacle, realize, that it got to 90 at one time. In fact, it got to more than 90 a couple times during 2008 when they were doing all the TARP things and the too big to fail thing with the banks, because the banks needed so much help, and we were gladly able to give it. Now, what I'd like to do now is to show you, someone's asked a question about crude oil, about where I think crude oil is going on a long-term basis, and I'm going to put up a weekly chart here because we've been in a very strong triangle here for quite some time. Well, it's almost like a parallel channel line. It's a pennant more than a flag. If you'll give me 1 second here, if I can get this thing in here. It's very difficult. There we go. And you'll be able to see that when crude oil was making its high back at 143 a barrel, if you remember, at 143 a barrel, Goldman Sachs was coming out, and they had price objectives of 200 to 250 a barrel. That was when it was hitting 143. That was the high. We completed an ABCD move at that time. The CD leg was a 1.618 expansion of the AB leg, but that's expected when the market is trending as strongly as that one. And we came all the way down to $30 a barrel during the debacle of 2008, 2009, and we rallied up to the 114 level. We've been between 114 and 80 for the past several years here. And right now we're looking at a market that's had lower tops come in, and the fact that the market could not rally more than $4 a barrel, given the fact that there was war in Israel and almost, a war, well, it really wasn't a war in Russia, whatever it was, that was didn't bring anything to the market at all. There was no fear at all coming to the market. So that's why we're, we watch it, because when crude oil really moves like it did during 2007 and 2008, and then on the downside, because if it can go from 143 to 30, it can certainly do that again. And because it's never regained its total bullishness, the best it could do is rally back just a little under 70% of the whole move down. So that's telling us that there is a great deal of supply of oil in the world. The rumor is that if we could get oil on a global basis under $90 a barrel, this would really hurt Russia, because all of their sources of income come from that area. Now, I also wanted to show you the chart for gasoline, because it has some of the same characteristics of these ABCD patterns, and it has been a lot more bullish than crude oil, because it almost went and made a double top during 2011. It got all the way back to $3.51 a gallon, and then we came down to $2.47. We're around $2.85 right now. So we're in a relatively tight triangle since 2012. And we're in the midst of the summer driving season, and not much is happening. Okay, we got the Dow down about 30 and the S&P up about 5.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can't use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I've had a request to take a look at the gold chart. Even with the Malaysian airline being shot down and the Palestinians and Israelis fighting again, gold was only able to rally about $25 to $30 an ounce. Silver was able to rally about 80 cents an ounce. So it's been a very, very poor rally in gold and silver, and they've started to sell off these last few days. And so that tells us that we're going to go down to at least another $25 to $30 to the 1282 level, and we still have the potential to going all the way down to test that $1,200 per ounce level one more time. I wouldn't be surprised if President Putin and President Obama go together and form a hedge fund, and that would be very bullish to the market, bearish to gold, and that might get the gold down to that price. Who knows? They're having buyouts all over the world. Maybe that'll be one that will one to be happening. Just remember one thing, folks. The paranoid person only has to be right one time to prove his case. So we'll see what happens someday. Anyway, this gold does look like it's heading to the downside. When bullish news can't get gold to go to the upside, it'll only drop of its own weight. And the first support is the 61% retracement at the 1282 per ounce. And then under that, we're looking at somewhere between $1,250 and $1,200 per ounce in gold. And should we go under 1170 per ounce in gold, they're going to turn the lights out at the COMEX exchange, because this market will head down to somewhere under 800 is what I would expect it to do, because after that high we made several years ago at 1932, we've never even approached those levels. Even closest we ever got was back, last August when we got to 1485. That was another big ABCD pattern that was happening at that time. So keep in mind that that's what we're looking at here. The Dow Jones is starting to weaken now a little bit more. It's down over 40 points, with the rest of the market still up. There's a perfect example of what Basil talked about, is two-tiered market. This New York Stock Exchange Index actually did not take out the highs of yesterday by more than 2 points, and that's an index that trades at 10,033, and that it went to 10,035. Now, I've had a request to take a look at the IWM, which is the small cap index, the ETF, and it's the long-term chart going back to 2007. And as you can see, we've made a classic double top up here at the 1.618 expansion, and it was also a very large AB equals CD pattern at that point. And this market has been far weaker than the rest of the market. It topped, 5 or 6 weeks ago, and the rest of the stocks, like the Dow stocks, the S&P stocks, have gone to make new highs, but the Russell's been lagging very, very badly. And another example is today, with the rest of the market up, the Russell has already started to roll over to the downside. So that's what we're seeing in this market that Basil talked about, early in the show. It's really fun to follow him, because anything that I'm getting ready to say that could possibly be a mistake, I listen to Basil and he already has it corrected for me. So I write it down just to make sure that I don't make a really bad mistake, which some of them you can't work yourself out of, but we'll see. Anyway, the Russell does look like it has made a classic double top up here, and it made a higher high, back in late June for just a couple of pennies, and then started to sell off. And usually when the market's really good, it's going to go blasting through that level without too much trouble at all. So we've had a lot of different things happening in the commodity markets. I'm going to cover these tomorrow, but as most of you know, wheat, corn, and soybeans have gone into multi-year lows. They're just a total collapse in those markets, and we're going to talk about those tomorrow. We're going to have Rich Anderson from Anderson Capital Management on as our guest, because we haven't seen anything like this since after the Russian grain robberies that we had during 1972 and 73. We had a collapse again during 75, and the 75 collapse led to the big bull market of 1976 that was so good to yours truly. I was fortunate enough to buy near the bottom, and I got lucky, and I got out on the high day just on being just flat out dumb luck. So I have to tell you the story behind that, because this might help you. Is one of the Larry Williams, who's one of my very good friends, he told me once there was only one indicator that he had that was 100%. It never failed, and that indicator, folks, is the calculator index. And that is, when you go over to the calculator to figure out how much money you're making, get out of your positions first, because you just triggered the greed mechanism, and that thing just doesn't fail. So when you're sitting there figuring out how much money you're making, you're in big trouble. This happened during the last week in March of 2000 when we were in San Francisco for the money show up there. Everybody was showing their equity runs with the NASDAQ almost at 5,000, and the next week it went lower and didn't look back till it took 85% of the value of those NASDAQ stocks. So I don't know if we're there in the market right now or not, but I think we're getting relatively close to that level. We'll have to let history tell us if that's going to be the case or not. If we close down on the week this week, this is only Wednesday. We have Thursday and Friday to go through. How's that for mathematics, folks? You think I don't know astrology? Oh, boy, I really pick up on this stuff really quickly. But this P index that we have today is pretty important, I think, and if this would happen to be the high day, that would mean a great deal. It would reinforce that cycle date is very important, and the fact that we did have a Dow Jones that could not could not even get unchanged on the day, let alone be up on the day. So that's what they're looking at. So we'll see what's happening. We've had just a minor sell-off in the the Nasdaq and the S&P. Nothing to really write home about. But these markets are telling us, at least from looking at the VIX index, that we're getting ready to start to see some really good volatility, much like we had during 2012 and 2011, where we had some really big swings up and down. And I don't think it's going to be like 2008 and 2009, not until 2015 and 2016 we might get there, because that'll be later in the cycle. But at the beginning of the cycle, we should be doubling or tripling what our ranges are, right now. So we're looking at a range of around 8 S&P points a day. That'll triple out to 24 S&P points a day, and that would really make for a really big fireworks, coming in to the market. And that's what we really need for pattern recognition. Is you need that volatility to get the prices moving and to see the things jump around a lot, because that's where the real fun lies, is when you see these patterns just explode one way or another. And it's amazing how these numbers actually work. It's always fun to actually do this. I have to tell you a fun story. I received a email yesterday from one of my students in China. He's been studying for a couple years with me, and he's done very, very well. And he asked me to write a letter for him to a hedge fund that they're starting in Hong Kong. And so I was able to do that. And I told, I said, to whom it may concern, blah, blah, blah about, working with the young man. But I told him, I said, if you had stock in this young fellow, he said, I'd put as much money into that stock as you possibly could, because this guy is going to be a really good long-term investment. So I don't know if he's going to get the job or not, but he certainly deserves it. And it's always nice to see young people that can do, pattern recognition and stuff. So it makes it a lot of fun. So we'll see what happens. Someone asked a question about the Bradley model, the fact that it is heading down, basically straight down through December. What about the Bradley dates? Well, fortunately, you have Steve Rhodes that comes on every day for 2 hours, and he follows those incredibly accurately. And so Steve alerts me, because I have a tendency to sometimes to forget to talk about him on the air, but he does alert them to me. And so make sure you listen to Steve's show, because he will have those dates for you. And they're just turning dates. They do have some type of a really strong significance. The problem is that they don't work all the time. But nothing works all the time, folks. That's the key here, is that nothing works all the time. I think that's the most important concept you should ever take out of speculation, is the fact that if you think you're going to find something that works all the time, go find another business, because that is not going to happen. This just doesn't happen. Now, I wanted to talk just a tiny bit here about the transportation index, because this market again has exploded into new high ground. It is a very, it's a limited index, but these are really big companies that are in this index, and so it is very, 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 very important. We finally we've completed, I think, three drive patterns here in the transportation index over the past month. We had one during June, and we had one during early July, and then we've got another one completing now. We had a big run up early in the morning, and now the transportation index is now down near the lows of the day. So there's one of those indications where maybe it's going to reverse and turn down. What I mentioned earlier about if the market would close lower on the week, after making a higher high like we've done today, if the market would close lower on the week, which that would mean the Dow would have to close below 17,030, I believe. That's about, that's not very far from where it is. It's only about 50 points from where it is. So if it closed below 17,000, that means you'd made a higher high and you close near the low, that's known as a weekly reversal, and those have a really high probability of following through. And since we've had virtually no 10% corrections here in the last 33 months in these things, even a small, 10% correction would be welcome to the community, I think, because it would offer a great buying opportunity for most people. And they would probably be right, because, this market is not just going to top and just go straight to the bottom. I don't think it will. It might, because it's going to be different this time, that's for sure. Okay, we've got a call from Florida. David, are you there?
Hi, Dr. Pesavento. How you doing?
Oh, it's no doctor. I'm just an old pharmacist.
Oh.
What can I do for you, my friend?
Well, the reason why I said that my wife's a pharmacist these days, they're making big doctorates.
They're doctors now, yeah. 60 years ago, they didn't have that.
No, sir. Hey, real quick, I meant to ask you, how's your friend Dr. Miller doing? I haven't meant to ask you last time.
I'm afraid she's passed away, David.
It
was earlier this year, and she still had 2 trades on. But she was in great health and fell asleep, and that was it. 93 years of age, and
wow.
She was really a wonderful person. Plus, boy, what an instrumental she was in my life, because she introduced me to the astrology, and it's really been a great pleasure knowing her. I used to trade for her son and her first husband, who passed away, and her son passed away about 10 years ago. He had a heart attack, but I hedged their crops when they were in Indiana, and when I was at Drexel, I hedged the soybean crop, but we had a Texas hedge on. We would be long the futures and long the cash.
There you go.
The market was going up, so it was a good thing, I guess. So.
No, I hear you. Every time, and you and I have known each other for a long time, every time you talk about it, you can just hear the love in your voice as you talk about her, and I'm very sorry to hear that she has gone on to be with the Lord. But that's good in my mind.
She was a really strong Christian lady, too. Sarah and I were there 2 years ago to visit her, and we went out to the farm, and Sarah had never been in cornfields that big, where they're 10 feet high. And, of course, Ruth is very short, and so we took pictures of us standing in the cornfield, and the corn stalks were at least twice as high as she was, but it's really a really important part of my life. I'll tell you, it was very, very sad. See, that trouble is getting old, David. These people around you start falling over, and that's that makes it tough.
Well, I believe in my heart of hearts that you have an eternal soul in your body, and that you live forever. But in any event, I was wondering if I could ask you for a favor.
Sure.
You put up, I was looking on the screen a few minutes ago at the beginning of the show, because I took some classes from you, and over the years I get your distribution list going. Okay. I was wondering if you wouldn't mind putting out that chart that you had out there, not the chart, but the write-up they had out there about, so many times and
the statistics, sure.
Yes, sir. If you wouldn't mind forwarding it, I would be enormously appreciative of that.
Sure.
I'd appreciate that a bunch.
I would be happy to do that. The information came from Zero Hedge. It was a few days ago, but one of my friends sent it on to me. But I do watch Zero Hedge every once in a while. But I'll send it out a little bit later today, because these are all the statistics. I mean, it's building a huge case, for what's happening. If I can ever get out of Bellevue, I'll have a chance to play it. But they're not going to let me out right away. I can tell you that. Hey, thanks for calling in, David.
Thanks, Larry. I appreciate it.
Good talking to you, my friend. Bye-bye. Dow down about 40. We'll be back in a minute.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the diagnostic box spread analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back, folks, and as fortune would smile upon me, we have the psychiatrist that admitted me to Bellevue on the line. Dr. Scott, are you there?
Hey, Larry, it's a pleasure to talk to you. You know,
good to talk to you, my friend.
I have a scattered thought here, so I'm going to sound a little confused for 30 seconds, and then I'm going to try to...
Welcome to the club, Scott. Welcome to the club.
You know, Larry, you talk about the grains going down. You talk about oil going down, the possibility of deflation. I only know that when I go to Walmart and buy a Stouffer's stuffed pepper, what used to be a meal for $3.50 looks the size of an appetizer, and everything else to the retail person seems to show that we have inflation, not deflation, and yet we're talking about the possibility of gold going down to $1,000, whatever it is. Oil's going lower, but it still costs $3.60 a gallon to get oil. I don't see deflation in my life, but it comes down to technical decisions if you're trading, I think. That's the bottom line that I think you would agree to. No matter what you think about what's going on in the store, you look at a pattern. If you look at the dollar index, like a daily dollar DX, to me it's in a broad trading range since November of last year. And it's in a range, and we can look at patterns that might evolve into ABCs higher and all that, but it's in a range, and the range follows the market moving lower from May of the same year. I mean, it looks to me that it's just a broad range, and I don't see how you can decide that the dollar will go to an ABC higher.
It's very difficult. You're right. You're absolutely correct. It's at a moment of truth, especially right now. If you look at the euro and if you look at the British pound and the Swiss franc and the Japanese yen, they're all at a very, very critical inflection points. The way I look at the charts.
Well, the importance of it is it can technically change the way you view the market. So it's I don't know how to make a decision on that. Do you have a DX? I mean, I can't remember what you've done recently. Do you think the dollar's going higher? Do you see an ABC higher? Do you see it ranging?
No, I think it's got a really good chance to head towards 82 and change without too much trouble. And if we could get it above 85, it could go. It used to be at 115 at one time. About 10 years ago. So the dollar has been in a wide range, for many, many years. But right now, on a shorter-term basis, and I'm talking daily charts going back several weeks, this 134.50 level in the euro is incredibly important. And just like the price in the pound that we hit last week that you so aptly talked about when you were visiting with us last week at that 172 level in the pound, certainly is held, and the pound sold off over 150 pips in a matter of just a few days.
Right. Well, the dollar, it's one thing to say if the dollar gets to 85, it could go higher. But it's at 80, 90. And on a chart, you're doubling the range. I mean, here, there may be a trade decision, and there's a big difference. I mean, you have to deal with what you have in the present tense. And to me, I just find it hard to see. You're in a contracted market. You're right in the middle of a range that's been
absolutely. And what I'm trying to do, Scott, is to take advantage of that, because I see that as a potential. And if I can, be fortunate enough to enter the market at the right time, my risk to my reward will be positive, and my expectation will be positive, and that gives me the trading opportunity that I'm looking for.
Okay.
Does that help you?
Well, I think it's in the. I think that if you see an opportunity, you have to be. It changes the way. I see you're at the end of the time here, but you have to worry about your target as well. I mean, you have a.
Amen. Thanks for calling in, Scott. Live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.